Hello and welcome to this episode of OmniTalk Global. This is OmniScience Capital's Investor Education Initiative. So, before we start, let me read out the disclaimer. Investments in security markets are subject to market risk. Read all the related documents carefully before investing. So, I have my colleague Dr. Gupta with me today, and we are going to discuss a more contemporary topic on the market levels. Now we have seen a fair bit of recovery in the market because in last 6 months, and specifically if I talk about numbers, Nasdaq is up around 38-39%, right? So very strong recovery. uh, S&P 500 is up around 15% year to date, so clearly on a upward trend.
Right.
While there are few things which are still, the Fed commentary has not changed. The interest rate, still talk about interest rate hike potentially, in the coming meeting.
Absolutely.
And while if you look at the inflation numbers,
hmm
they been on a downward trend. Okay.
Absolutely.
Last, CPI number was around 4% last month. Expected, like, if I just look at the trend, it is expected to be lower.
Right.
Uh, uh, but so there is, probably if the interest rates were hiked to control inflation, and inflation has already, there's a case to be built for the interest rate cuts going
Absolutely.
forward. And while people are trying to react to the market levels, there is a lot of uncertainty in terms of what the investor should do.
hmm
So that is something I think we can discuss and see, how people should look at this interest rate cycle, and how to react to the top line numbers, or like,
Right.
the return numbers.
Yeah. So, see, the funny thing is, throughout this period, people were continuously
Did
waiting for recession,
recession. Correct.
and the market could go down.
Right.
And they were waiting for all these things,
Right.
and all these big banks were talking about, the sell side analysts were
Correct.
coming out with strategy reports on
Correct.
how markets will go down further, etc.,
Absolutely.
etc., right?
Absolutely.
And how economy will enter a recession because
Hmm.
of the yield curve inversion,
Inversion. Right.
right? So all those kind of fun things people kept talking,
Hmm.
while obviously someone was allocating money,
Hmm. Correct.
and uh, someone big was allocating money, right?
Correct.
So
Right.
it's not a person, but like all the
All
Mr.
the
Market put together.
right.
I mean, so you can say that Mr. Market is not really that stupid either,
Right. Right.
right? It's many times they do stupid things,
Hmm.
but a lot of times
It's
it's very calculating
collective.
as well,
Right.
and they are allocating
Correct.
throughout,
Correct.
right? And so I mean, these are crazy numbers, right? I
Right.
mean, like 15% up in about 6 months,
Right.
and 38% up is really
Correct.
huge
Absolutely.
upswings.
And in
And
fact, if we like look a quarter back, uh, S&P started going up from October itself, S&P
Mhm,
500,
right,
and from the bottom it has recovered almost 23%.
right, right.
And if you map this data with the inflation numbers,
hmm
inflation peaked around June
Okay,
last year,
sure,
and then it was coming down.
right.
Though by, let's say, October, November, it had only come to some 7% level,
hmm
but someone was kind of looking at the trajectory and establishing that, okay, interest rates will, while the inflation numbers come down further, the pressure on interest rate hike will also be,
Reduced,
lower,
reduced.
go
So they will eventually have to
up
cut,
to cut.
right?
And the market, someone started allocating money
Right.
right
And
then.
markets work in anticipation, right?
Right.
So
Right.
Mr. Market anticipated
Right.
and started allocating,
Correct.
and the net result is where we see we are.
Right.
While still the Fed is reducing the liquidity, right?
Yes.
And
Yes.
despite that, markets are
Markets are
up significantly, and people are still waiting for recession.
correct.
Yeah, the
Correct.
negative GDP, 2 quarters of negative GDP, which was not declared a recession
Right.
in the first half of 2022,
22.
right? So it was not a recession,
Right.
but all the discussion of recession started after
After.
that,
Right.
and it's never come back,
Come on.
right?
Absolutely.
The unemployment rates are still one of the lowest
Right.
ever,
Right.
and 50-year lows or things like
Hmm.
that. Uh, and so economy continues doing quite well.
Well,
Inflation is consistently going down,
right.
right? And which we have been pointing out from
Yeah.
from let's say July, August, September onwards, we have been saying
Correct.
that look, it's already
Down.
consistently going down. Uh, Initially, in fact, it was going down probably around 1% per month,
Absolutely.
and now it's like 0.5% per
So,
month. You know, so if I just extrapolate that, although we cannot say that will happen,
right.
but and every month it doesn't go down by 0.5%.
Yes.
But if you extrapolate the rate of 0.5% per month, then by end of the year or before the end of the year, we are below two.
Two. Right.
Right. So we can't say what will happen, but it looks like that things are quite in control.
Right.
And of course, Fed is worried about a bull market or a bubble getting created, etc.
Right.
So it's trying to control with the hawkish tone, right? But already the markets are up, the stock market and the bond markets are also, the yields are going down.
Right.
Right. So although the last Fed meeting, they have clearly said the two hikes probably remaining in rest of the year, right? According to their dot plot. Right?
Yeah.
Again, it's not a prediction, but it's the sum of each individual
expectations
in the FOMC's expectations, right? So, and it's their job to be hawkish at this point,
right.
But the facts are going to force them, probably. It looks like, we cannot predict exactly what will happen, but if you look at the inflation trend, inflation is a trending kind of a thing, where the trend continues, because when it increases because the supplies are not coming, demand is high. That was the reason why that happened, and now it's kind of, I would say, proven that it was a supply chain problems which caused the inflation rather than too much money, right?
Right.
If too much money, then it's still there.
Right.
Okay, it's still a lot of money, and the job markets are full and so on.
Right.
But inflation is
It is
clearly
already
coming down.
Right.
So, and if I extrapolate that trend, which it looks like it makes sense, because when the supplies are coming in line
right.
with the demand,
Correct.
then eventually it should
Exactly.
go away, right? So somewhere within, from now to end of the year,
Right.
it will go probably below 2%.
Correct.
Which means Fed will start cutting rates probably even before it does that, right?
Yeah.
Because you are at 5 plus,
Sure.
and you need to, the base rate you are saying the normal rate is 2.5.
Right.
So this is like, so many cuts to be done. But inflation is probably coming very close to your target very soon.
Right.
Of course, they will not move until that happens.
Right.
Because of historical baggage, right?
Yes, it can spike again, or it can remain persistent.
I mean, last time it took like decade or and a half or 2 decades, or more than a decade for sure, to control inflation, right?
Right.
So you can just
I was just looking at numbers in 2000, 1969 to maybe 1981, 82, and there were three spikes after, with a gap of 2 to 3 years.
Interest rate spikes.
Yeah, interest rate spikes where interest rate was required, like it was there in 2 to 4% range, right, from 1950s to 1965 or 68, and then it spiked. Exactly, I don't know what were the economic conditions, but it spiked, and inflation would have spiked, so interest rate would have been increased at that time, and it went up to 10%, and then another spike of interest rate was seen in 2 years' time, where they had to take interest rates to 12%.
Around 74.
74, right. And so they brought down interest rates in 75, and 78 again they had to increase. And take it to 18-20%.
Right.
So they are like, if we too early to cut rates, maybe if within a couple of years or in a year we might see another inflation spike, and we have to.
That is the worry.
Yes,
that is the worry in the Fed's mind, or a lot of people's mind. That last time it took every time you started cutting, inflation went up again.
Right.
So yeah, so we can understand where the Fed is coming from, or where all these people who are saying, all the so-called strategists, that it will, inflation will not go down, and you need to keep high interest rates, and then markets will go down, and then you have to tank the economy.
Yes.
And push it into a recession to control inflation for the long term, right? So this is that theory,
Right.
or the reasoning, or the data is coming from that,
Correct.
right? But that's about what, 50 years old now. We're talking about something
Correct.
which is
Right.
50 years back.
Hmm.
Completely economic conditions and how the economy is structured is completely changed, right?
Agree.
That time it was mostly domestic economies,
Correct.
developed countries controlling the
Right.
economy.
And I think that time, like clearly the concept used to be that economy got into a overheated mode, right? And then you wanted
Right.
to slow it down
Right.
because over capacity expansion, over
Exactly. Absolutely.
investments were happening,
Right.
and then you
Right.
increase the rates to slow down those
The
things.
typical economic boom and bust cycle.
Right?
It took 3-4 years to
Yes,
keep investing, and
and
then a project would come,
right?
and so all these cyclical things would happen
Exactly.
because everyone would
Right.
construct, and there is
Right.
overcapacity 4
Right.
years down the line.
And when you increase the interest rates, so obviously investments slow down and consumption slows down. So you will see a recession followed
Right.
by an interest rate hike, and
Right.
that's the model people knew,
Mm.
and just they wanted to apply right now. Right, now
Right.
the interest rates are going up.
Right.
The recession has to come because
Exactly.
while the origin was not overheating of economy, but
Exactly.
the supply side constraints, which
Exactly.
is what we are trying to that you can't just keep putting two things together, that
Right.
interest rate hike means recession, right?
Exactly.
If it is just to counter
Mm.
the supply side pressures, and which
Right.
anyway, even if you do something or not, they are going to get relaxed out,
Exactly.
as supply improves,
Exactly.
which is what I think has happened.
Exactly. And secondly, now it's not as much of a capex driven economy either,
Exactly.
right?
Right.
Worldwide.
Right.
There's already too much overcapacity.
Right.
And in fact, so just to digress for some time, I don't want to focus too much on it, but this concept that, because Fed is printing money, inflation should happen, and they kept
Correct.
saying it from 2009 or
Right.
2008,
Right.
that it'll come, it'll come, it'll come.
Hmm.
And now, then they were
Right.
able to declare victory in
Victory.
2021
That
that,
inflation
it's
has,
come now,
yeah.
and
It took
so
more than 10 years, but
yes,
see, finally, and
see,
it came in a crazy way, right?
yes,
It went
yes,
up to 9%.
yes. See, I told you so.
Really, so. Right.
But I mean, that inflation which you were waiting for because of printing money, I mean, just turn it around, and probably because of such high productivity of technology,
Yes.
right, in the last 20 years
Right.
or maybe more, and especially in last 10,
10
15
years.
years,
Yeah.
probably there's too much capacity or production
Correct.
capability worldwide, right?
Worldwide.
Capacity. And the worry should have been that you're going to fall into a deflation,
Right.
and by mistake,
You kept
all the banks kept printing money, and
and
so you didn't have as much
yes.
of a deflation,
Right.
and you
You
escaped the
avoided.
deflation
Yes.
trap.
Exactly.
And this inflation thing just happened temporarily because of supply chain congestion, because of the
Right.
COVID lockdowns, right?
Absolutely.
And now that is kind of more or less gone.
Correct.
There might be in few sectors or few particular products, it still might
Right.
be here and there,
Sure.
but on an average, that's gone.
Yeah.
So you still need to worry. Now you need to worry even more
More.
about deflation, right?
Correct.
Going forward,
Right.
because the technology, productivity, and all that.
Is going up, right? Exactly. So, because moving on, I think we kind of discussed enough on the inflation, recession, interest rate cycle.
Sure.
Now, markets have a relationship with interest rates because
Yes.
it serves as a
Yes.
discounting
Absolutely.
factor.
Absolutely.
And typically, we have seen that increase in interest rate cycle. Typically, people expect recession, so that's another reason why the markets can fall.
Yes.
But it's a mathematical relationship as well.
Absolutely.
So, in that view, how do you see now? The way it has gone up, and if the interest rates were to cut, how do you see that
Sure.
impacting the market
Sure.
levels?
Sure. So first, so there are two things, right? One is empirical evidence, or
Right.
what is that telling you. So you think about, and then we'll come to the mathematics or the
Sure.
present value formula or discounted cash flow,
Yeah.
etc. Right. So the first thing is the throughout the 70s, in fact, the famous headline, Business Week headline, death of equities, right?
Right.
So the stock market fell from 69 to 79,
Right.
and it was actually at the bottom,
Right.
somewhere from 79 onwards up to 81, 82, right? It just remained down. Now, finally, So interest rates were getting hiked
Right.
throughout the
Right.
70s,
Right.
right? And when interest rate peaked at, let's say, 81 or
Right.
82, then after that the interest rate started getting cut,
Correct.
and you had like a 30-year bull run, right?
Right.
So
Right.
continuously till the dot-com boom,
Boom.
they
Yes.
just kept cutting, and it kept booming.
Absolutely.
And then they started raising interest rates, and then you had the
No, no.
bust,
Right.
and then again you started cutting, and you had the boom from 2003 onwards to 2007 8,
Correct.
and then again you started cutting,
Yes.
and you again had a kind of fine. I mean, from 2009 to 2011 12, you can say kind of it went up slightly, then there was taper tantrum, etc. But from that point onwards, you had low interest rates, and market kept going up.
Correct.
Till uh, 2018, the hikes started, interest
Correct.
rate hikes, and again it went
Market.
down in 18 and 19.
Right.
And then 20, again the COVID recession, I mean the COVID lockdowns happened,
So there was
markets
a cut.
went down, and there was a huge cut,
Cut.
and markets again went down.
Right.
And again now, because on the back of inflation as an excuse, I
Right.
mean, see, Fed was trying to normalize, right,
Right.
interest rates from 18 itself.
Right.
They
But
were that
now-
time it required hiking,
Correct.
and they got a good excuse with inflation,
Right.
and definitely they made full use of it
Yeah.
and kept
Got it.
increasing. And now that has been increased, and now you can again start bringing it down to normal interest rates once inflation is gone.
Correct.
Right? So that is what the Fed is trying to do, and we have clearly seen that every time they hike,
Hike.
markets go down. Every time they cut, markets go up,
Correct.
and slightly in anticipation
Right.
of the
Also-
actual hike and cut,
Actual,
right? So
absolutely.
it's not after the hike
After the-
it goes down.
but
It
in
went down
anticipation.
in
Exactly.
anticipation.
Correct.
So if I extrapolate that
Yeah.
on an empirical basis, then 24 is the year 2024 when it will be interest rates are going to go down.
Right.
So you can expect that markets in anticipation
Already started up, and then they can
and
continue.
they are likely to continue. Of course, there will be hiccups and all that. Could be.
Right.
So this is the empirical basis. Now coming to the more stronger mathematical basis, the risk-free rate is in the bottom, or the discount rate
Right.
is in the denominator, right? So when you increase the number in the denominator, the total number of this equation will be lower.
Right.
And when you reduce it,
right,
this number will be higher.
absolutely.
So now that mathematical relation is very, very clear. It's not a correlation, it's a mathematical relation.
Right.
If you reduce this,
correct,
intrinsic value of a stock or any asset, including the overall market, will go up. If you increase it, intrinsic value will go down.
Right.
Okay, it's a mathematical relation.
Correct.
You cannot dispute that. It's just there.
Right.
Okay.
You can dispute that which number or what adjustment you are doing.
Absolutely.
But that's the nature of the equation, right?
That there is an inverse
relationship. Right.
And again, markets are complex because the numerator also matters in the market.
Correct.
Right. And all of this is for perpetual situation.
Right.
So it's not any particular year what will happen. So if a recessionary period, long recessionary period is expected for the market, I mean for the economy, then the numerator itself goes down. Right. And you are increasing interest rates on top of it, then the whole thing says that the intrinsic value estimate is very low. Right. And another thing is, this is very sensitive.
Yeah, because of the time horizon. So though you would expect that that discount rate is actually your kind of your opportunity cost, or the cost of capital that you expect to generate from equities.
Exactly.
So it should be more or less stable and a long term number.
Absolutely.
But you still adjust it with the interest rate or the free rate, rate. You still do that. But because of the sensitivity that you mentioned, so even a 0.5% here and there basically changes the intrinsic value number
drastically. So I would say like plus 1% or minus 1%. Yeah. If you take, that's a 2% range, right? Right. That will probably fluctuate the intrinsic value by more than 50%. Okay. Okay. So it's a huge number change. It's highly sensitive. Correct. So of course, doesn't make sense to use the short term risk free rate
Correct.
uh, as an
Right.
input
Right.
and then wag it that much.
Right.
But people do that, and that's why the markets keep
Markets are
going up and
so
down.
volatile. Yes.
Yeah,
Yes.
volatile.
Yes.
But I mean, that is how it is.
How it is.
We're
Right.
just trying to help you think through and understand that these are the kind of things going on
Right.
behind those market fluctuations.
Sure.
And keep in mind, economy continues being very strong,
Right.
better than expected. So the
Right.
dot plot in the earlier dot plot before the June
Right.
one, it was expected that the economy will grow only by 0.5%,
Right.
US economy in 2023. Now they have to upgrade it to 1% already
Yes.
in June itself.
Right. Right.
So unemployment, they were trying to spike it to 4.5, but it
Right.
remained,
Remained
from 3.5, I think, or 3.4, went to 3.7.
7. Right.
So it's still below 4. Okay,
True.
despite you trying to kill the jobs
Correct.
openly. So
Correct.
it's not happening. So economy is strong, and the companies are also reporting better than expected numbers.
Right.
Right. So companies also use the opportunity to say worse things and
Sure.
then outperform that.
Sure.
It's all that has happened, and it will continue happening. So you keep all these things in mind. Economic factors,
Yes.
they look quite decent to us, but you make your own
You know.
conclusions as to that.
Yes.
Same way inflation numbers, and
Yes.
same way on what do you expect the Fed to do.
Absolutely.
And then what is the response you expect from the market.
Great. So great. I think on this note we can end our discussion.
Sure.
So this to basically guide the viewers how they can go about making their kind of assumptions or models around market outlook, and we are happy to take any queries that you might have on this discussion, of any questions that you need kind of more discussion on. You can send us you comment, or you can send emails to us at info@omnisciencecapital.com. And thank you so much for joining us.
Thank you.